Alright, so I want to show you guys my trading strategy. So first of all, what we're going to do here is diagnose problems when you're trying to combine indicators into strategy. First of all, going into this strategy, I'm using MACD, RSI, and trend, and then one more thing, which is a derivative of volatility, which is simply price movement. So instead of comparing it to the mean, just saying what's the price movement. Okay, so with that out of the way, let's look at some examples of how you can analyze and see if you can do anything better. So for example, here let's just look at some trades and see if we can find problems, right? For example, here we see that we're trading sort of closer to 100 MMA, which is SMA, which is good, right? That would be, you could base a lot of other strategies on that as well, right? Where it breaks down and it's going to continue down, or it breaks out and it's going to go into an uptrend. So by using this trend indicator, we aren't trading breakouts of this trend. We're trading breakouts of the MACD instead, right? Like crossing over. And what happens is we want to trade with the trend. So when the slope of the trend is at a certain angle, or the slope of the SMA. Now, if you look at this, what is your first thought? Look at this. Okay, so if I look at this, what I would be thinking is I don't want to take 4 trades here. So what I might want to do is make sure that each trade that I do is sort of for a separate reason. Because honestly, this is just 4 times the same trade. This is all within the same range. If you look at the range of my trade, you know, I should be moving up and down a little bit, doing different things with the chart. Having a different reason by that point to take a trade, right? So here I hit the profit margins. Here I'm not taking any trades because it's flat. Here I'm not taking any trades because it's flat. And then here you can see a short entry, which is a little bit iffy. Look at this, right? So it went really sharp, went up, but really here I went up and the 200 SMA didn't catch up yet. So here as well. Apparently here I was still on a good slope, so when this trade was initiated, it was still registering that this was sufficient slope downwards. Really, at this point, we weren't, like, could you be sure of this? Like, you could trade this long. You might want to wait for confirmation and think this is going long, right? Honestly, this looks like a horrible trade setup, and the reason for that being is that the trend is lagging too much. So I might need closer look on the trend. That's the first thing I want to talk about. Okay, so now let's look for more examples. You see a stack over here. And then I see another issue, which is, honestly, 14 trades is not a lot. So if I want to do this strategy and cull out more of these silly trades, I will either have to loosen up and trade lower margins, or, which I think is way better, I will have to simply instead toughen up, make sure the percentage win rate is, and the profit factors are higher, it's more consistent, and then what I'll do is I'll try and apply this to many different stocks. Even if I have to do it manually, if that's an hour per stock, let's say I take 40 stocks, that's a full work week to set up your entire system, right? And that system might work for years, right? So that is absolutely worth it. Okay, so look at this. This is a good example. So when a human looks at this, right, it drops really, really hard. And now it hit the lowest low, right? It would be really surprising if something that isn't really crashing down, right? It's hitting this line of support over here. This was crazy low values, real bargain, right? Any human would be like, yeah, this is a real bargain. Like, wow, great price for Bitcoin. I mean, that's just amazing. I can't believe I didn't catch this super low price here. I really wasn't looking at Bitcoin, but yeah. All right, so look at this, right? Anyone would take this as being in a downtrend. And then here it stops and it reverts, right? And that's another example where the 200 SMA is like, nah, this is just like sloping down, right? It's like 200 SMA is like, yeah, we're still like this. But honestly, in this case, an EMA would make this very significant when this is happening. So it slopes down harder. And then this very significant and make it slope up more, right? So really, in this case, we are not any longer in a downtrend. We're in an uptrend here, right? This is very clearly, this entire part, this was clearly an uptrend. And we should only be taking long entries here, right? Any shorts are just scalping little pullbacks, and that's not what we're doing in this trading strategy at all, right? So you can see how just a trend indicator accounts for almost every single losing trade we made. Okay. So next question is, how do we solve this? So I already alluded to how I might approach that. One is to make it exponential instead of simple, right? And the next one is to reduce the amount of bars, right? Those are the two main options. So let's try that. Let's say we take different... Let's just try out indicators and look at it visually first, and then start scripting it up, right? Just see what's happening. Built-ins. Wow, that took me a long time. Okay, so moving average, exponential. Weighted. What is weighted, actually? Is that volume weighted? Like, weighted tells me very little, right? Weighted tells me exactly nothing. So I'm gonna Google that. Weighted moving average. Make sure that you know what you're dealing with. To the most recent data points. Okay, and what is an EMA? Exponential moving average. Because then I want to know why that's not just called a weighted one. Exponentially weighted. Okay, so that's just weighted heavier. Okay. So just make sure that this is of length 50 or something like that. Let's say it's length 200. What? Numlock, please. You're killing me here. So here we were kind of just coming down. I'm not sure if I like that. These long entries still make sense. This all makes sense. It's really about this point where the 200 MA fails to do what it's supposed to do. And then hopefully I can create a signal that follows the 200 MA enough and then breaks out here and just make sure that it exponentially weights this. So let's try exponential weighting instead. Because this... First, let's try 50. Let's just the length. See what that does. I'm very afraid of little spikes like this. So this is a good example where I would say this is not an uptrend, right? And the 50 MA is just like, yep, we're going up. So I do not like that. I don't want to have that. One thing I can do is ask if the 50 MA and the trend indicator agree. But if they disagree, I wouldn't trade. And that's the problem, because here I do want to take trades that are long. So make sure you ask yourself, you know, how many signals on the positive and on the negative side are you losing because you're solving a certain problem, right? More indicators, blah, 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 blah. Okay. Okay, so take the exponential. Moving average exponential, yes. And adjust that length. First to 200 again. Just see what that does. Okay. Yeah, not gonna lie. Like, after such a big drop, I feel like this is not part of any larger trend. So, this begs the question. If the price increases or decreases high enough and then fluctuates, does it signal a different trend where I should reset the indicator? That's a big question. So what I'm looking for here is, how can I make it understand this to me is like, this is all noise, right? This is down. And after you go down, you can enter a different cycle where you just don't really know what's happening. It's kind of consolidating here. After consolidating, doesn't really do anything here, right? It's like it's very stable for a while. There's no good trades there, right? I wanted to understand that if we entered a period of consolidation, then when it changes the cycle that we're in. So this would be a good indicator that we changed general market conditions. And look at this, right? If you take this as a starting point for the next phase of the market, you can see that there's increased volatility occurring very soon into that market, right? Or at least momentum. Volatility and momentum both score higher, right? So you can really say that started with this. It was flat for a while after that, but really this would be a good indication, like, that's pretty weird. So for example, this one wasn't as big. This one was like twice as tall, right? That one really stands out. Okay. So I'm still not sure what to do about this, because I'm always going to be lagging behind if I try and just do it by an MA like this, right? Okay, so how can I identify different market cycles or conditions or whatever? Let's say I'm like this, right? And suddenly this happens, right? Now, what happens after that, it could consolidate with noise or without noise, and then it could maybe start an uptrend or whatever, or it could go down. It could do a lot of things, but really, when something is happening and something breaks out of it, you want to say, okay, this was one phase of the market, and now we're going to wait for the next phase to display. So let's say if this goes like that, you wouldn't say that the MA is like this, right? You wouldn't say like, oh, here we're still like on an uptrend. No, we would just started a different market cycle, and I would say this is just a noise point where we don't have any information on the new trend yet, right? Which kind of conforms with, you know, this idea of two separate market phases, you know. So, for example, when this happens, I don't know yet what's going to happen, right? And then when, for example, when we have a little bit of bullish momentum here, right, I would say this is classic example of, all right, we're going up, right? This is an indication of a trend upwards. So as soon as it hits this over here, this slope up, I'd say that's a good moment to start trading again, right? Okay. Now this move was from... Now how am I going to code this up? So I might say something like, if the volatility changes by a certain percentage from one time frame to the next, something's going on. So if it's going up and down constantly, that's fine. But if it's going up and down and then consolidates, that's a signal that we're into a different market phase. And if it's consolidating and breaks out, that's also a signal that we're headed into a new market phase, right? So just drawing that out very simply. This is a new market phase, and that one as well, right? So that way, when this happens, right, you have a certain amount of volatility pretty consistently. Suddenly, boom, right? This means that we are into a new market phase. And that's it, right? So once we start working with that, we ask, what was our lowest low if we went down, or our highest high when we went up? And then ask what happened after that, right? I'd say this doesn't look to me like, if you say this is the end of this cycle, obviously this big move down is kind of noisy. I wouldn't know if this is the start of a big saw down, or if this is just a little bit of noise where it continues to rally up after that, where it's just like we're making up for this last value here. I don't know, right? That's noisy. I don't want to trade that. I don't want to trade thinking I know what will happen. So really, I feel like after hitting lows and recovering, that's when I'm pretty certain, like, this would be very strange if it just collapsed. Like, then I would be like, what? Why? Right? So I'm willing to take that bet that this does not happen. And set my stop losses in this area below. Alright. So, how are we going to code that up? First of all, price movement's kind of silly. I feel like at this point I'm going to copy the script, open up a new one, and I'm going to make a new one. Volatility. Okay, so for this version, so I'm going to try and get the trend correct, right? Alright, that's a bit pretty basic layout of our strategy, right? And then 2, what are we gonna do with volatility? I need to find a way to calculate volatility in any time frame. Then I can compare volatility between 2 time frames and establish what is a reasonable, what is considered extreme enough to for a new market phase. Alright, so that's it. That is our basic layout of the strategy. Alright, now part 3 is going to be actually trying to code this up. That might actually take a while. So, make sure the trend is identified correctly. How do we do that? Calculating volatility. So we have to start with volatility calculations. Now volatility, as I understand it, is price change relative to the mean. Calculating volatility. Alright, standard deviation is the typical statistic. Okay. Oof. Ooh, 68% between... Okay, that's crazy. Alright, that's pretty crazy, right? So this is a very interesting article. This is exactly what you want before you go into like coding things up. Really try and get a grip, because that's a sort of pitfall for people like me where you don't have enough knowledge yet. You start coding and then you start figuring out that what you're coding makes no sense and is kind of random. That's really dangerous. I like how accumulation and distribution are sort of opposites to one another. And then markup is really just a unique thing related to consolidation and breaking out of consolidation. And then downtrend is a unique thing relating, to sort of panic in the market where people are just selling. But really, this doesn't signify. I'd say there's no real indication here of what happens when there's an extended uptrend. So accumulation is early on after a bottom, right? Markup is when it's been stable for a while and moves higher. But what is an extended uptrend according to these four, cycles? So I'd say the uptrend has to be a fifth one here, right? If you classify downtrend as a phase, I just don't have any way to classify extended bull runs. There's just nothing in here. It's not an accumulation phase, because it's not really early adoption after a while, right? Markup, well, not if you're talking about consolidation and just sort of breaking out. That's markup, right? It's not really what I'm talking about either. So really, there's no way. All right. Okay, so that's good information. That gives me general ideas to work with. Okay, now let's go back to volatility and learn a little bit more. Return distributions are typically asymmetrical. Heteroscedasticity. Okay. Alright, so the variance is different across different elements of a data set. Okay, what is this random disturbance thing doing in here? Ordinary least squares, yeah, I know that one. It's still unbiased, okay. Inefficient. What does that mean? Inefficient. Like this is getting very technical. There you have to like start understanding econometry at a rather good level. Okay. So this takes previous volatility. This seems actually to be what I'm looking for, right? So this is taking volatility as a measure of previous volatility, right? So then so if I want to take the value of the new volatility, I have to compare it to previous volatility. And what this is saying essentially is that, let's say if the standard error of data points is moving up, here it's essentially, as I understand it, that describes the variance of the current error term as a function of the actual sizes of the previous time period. So let's say, right, if I compare this to this, I would say, well, this is increasing, right? This is increasing. Maybe it was over here. It is generally increasing over a long period of time. And then this itself, when I take those values, I might say, well, it's generally increasing. Now, let's say if before that I was, let's say I had a very consistent phase, and then I broke out a little bit with my data points, right? And then I broke out even further, and then it collapsed again. This compared to this is zero change, right? But obviously this compared to this is a very big change, which might be used as an So this is really a formalization, like Nobel Prize levels of formalization of whole bunches of theory, whatever, computer models and whatever, formalized mathematical models of the same sort of general concept of taking previous volatility as a measure of new volatility, which makes a lot of sense. Okay, so part 4. I really hate formalized mathematical modeling. It takes me so long to get through it. There's like 10 different methods: CoGarch, iGarch, FGarch, TGarch. There's no sort of indication of this. This is kind of like the stuff you would encounter in a lot of lectures at a high level of econometric studies, and then you get example use cases and blah de blah, but here it's just like, here's some numbers, like that it has no significance. It's like if you told me what the quadratic formula was without any context on the quadratic formula itself. So really that's just not readable. Okay, so autoregressive conditional heteroscedasticity. Heteroscedasticity, okay. Heteroscedasticity. Moving over time. Special considerations. So it might be skewed. There might be extended periods of being off of the mean. Volatility might experience unusual periods of high volatility or low volatility, right? Would be nice if this was a bigger and clearer image, but alright. Okay. So that is a nice perspective into when people say, yeah, just buy the S&P 500, right? Like, you can get some pretty big variance in your performance. It's like when people say, well, hedge funds are a failure because they don't outperform the S&P 500. Well, who the heck said that was the goal? The goal is to manage risk, and to usually there are certain objectives that a fund wishes to obtain, and a high return on investment is just one of those goals, right? It's not like the end all objective, because obviously if you lose 50% and then gain 50% and then gain 50% again, you get a good return on your money, but that doesn't mean that you were willing to go through that risk, right? Go through with that risk. Experienced a gain above 1.1%. Okay. His numbers are really hard to read, but I think it says 3. There's a number missing here. I think. Why does it say 325? It's kind of weird. Alright. So the frequency isn't really indicated on this chart. So this is 10%, 5%, Like this bar is 5%, but it's very thick. But the thickness has no meaning, I think. This looks like something constructed in paint, honestly. Looks very, very bad. So, yeah, I don't really understand. This looks really bad. Okay, that didn't really tell me much. Okay. How not to make a readable chart, I guess. Well, heteroscedasticity is one thing, but also the entire conditions for the stock could change. So let's say if I go and do heads or tails, the coin doesn't change. Now let's say I change the parameters of my coins. Obviously, it could change the rate at which heads or tails occurs. It could change, I don't know, the kurtosis, skew, heteroscedasticity, whatever all those variables are. Like change any of that, right? Could change the whole thing. And that's the same thing with the S&P 500. If someone lands a nuke in America, it might fundamentally change the performance of the S&P 500, right? So in that case, you can't really say, well, it's the histogram doesn't work because of heteroscedasticity. You might say, well, it doesn't work because the fundamentals of the distribution, of what determines the distribution, have changed. That's a very dangerous proposition here, in my opinion, to assume that's the only drawback, heteroscedasticity. Okay. Tough stuff. So that actually helped me learn and understand the basics of volatility, and that I should first calculate volatility as something as easy as standard deviation, and then I should construct a series that measures, let's say, something simple like the derivative of that, right? So let's just measure the rate of change of standard deviation, and just say, well, if the rate of change, if you formulate that as a moving average, if that exceeds a certain threshold, so volatility is suddenly spiking quite hard or contracting quite hard, then I can say, well, that's a different market cycle, right? That we can identify. Maybe we can even construct indicators to identify these different types of market cycles, like here, the markup phase or whatever, right? So there's a lot of potential here for algo trading in conjunction with a basic strategy like this. So honestly, I think this is going to take a long time for me to implement. I don't think it'll be a lot of fun watching me struggle with basic coding syntax. That's not really the purpose here, which is probably what I'm going to be struggling with the most if I know myself. Because of that, I think it's better to just demonstrate to you how I go through all the different cycles of diagnosis and information gathering to get to the point where you can code something up that has meaning and value and achieve what you want to. So I will show you the results in a later video. For now, I think this is a good demonstration of how I went through diagnosing stuff, then trying to establish what's going on, how can I calculate that, what can I do. That was pretty contrived, right? Pretty mathematical stuff. It was a lot of fun. So I hope you learned something from that. If you did, please consider liking and subscribing, of course. I mean, hey, that would be very nice. And if you have any thoughts on this topic or, able to help out, then please do reach out in the comments. And I'll see you hopefully in the next video.